Welcome to the Value Investor TV podcast. This is the podcast that helps you grow your wealth and become financially independent. My name is Becco and my partner, Captain America.
That's right.
Welcome, guys, to our second episode of TransDigm Group. In this episode, we are going to talk about the financials, management, and the valuation of this company. Exciting company, interesting company, kind of a monopoly in this space. So if you guys haven't checked out our first episode, do that before you come to this episode. That'll give you a little bit more background on TransDigm.
Yeah.
Hari, can you give us a disclaimer before we start?
Yeah, this is the Value Investor TV podcast. This is we are here to educate you and entertain you on the finer points of value investing. We are not financial advisors. We don't know your specific financial situation. So before making any investment decisions, please consult with a tax or financial advisor.
Excellent. Hari,
right.
You want to mention a few things about housekeeping items?
Yeah. So, this particular episode, TransDigm was mentioned to us, or was asked by a listener for us to review. And you can, if you'd like to do that, you can send us an email, info@valueinvestor.org. We are happy to take email either questions or send you the checklist, which we have been using for the podcast. The other choice is we are happy to announce that we are using, Becco and I use Slack to privately message each other. And if you'd like to get an invite to our private Slack channel, be happy to have you. And we'd be very excited because we can actually communicate with you all in real time. So you can send us an email, info@valueinvestor.org, and we will send you an invite. As part of that, you're happy to ask questions. Hopefully we can start making this community more, bring you guys together and have you all make suggestions, give us feedback, and maybe even give us discussion points for the next episodes. So we want to make this as much about you guys and what you would like to see, rather than Becco and I coming up with terrible ideas, like changing the intro on the previous episode. So
we would like our community to help us with our intro, because I feel like we could do a better job there.
Maybe.
Hari is doubtful, but
yeah,
I'll leave it up to you guys.
Okay, so in the last episode, we kind of walked through some of the business fundamentals of what TransDigm does and their competitive advantage. And if you haven't heard that episode, it's probably good to start with that one before we start talking about the financials. I think it's important that you all understand, when we go through the checklist, we don't look at the financials first. You can use the financials to kind of say this is a good company or a bad one just because of, certain things. But the business itself is very important. Understanding what the company does in the context of the financials tells you, everything you need to know. A lot of people kind of, segment them out as art and science, where actually they're all together, right? And so, we had talked about TransDigm, as a airplane part manufacturer, but they were kind of the sole source provider of these particular parts. And so when we look at this company, what we want to see from the financial aspect is any business that, they may be the sole, provider of a particular item, right? My daughter is the sole provider of artwork for me, right? But that doesn't mean that artwork is valuable, right? I find it very valuable, but, other people may not, right? Because she's only 7 years old. So if you look at this company, how good are they at translating their moat, which we thought was pretty significant, into high returns on capital?
Yeah. So high returns on capital. If I could just look at my spreadsheet really quick. And so one thing that I want to discuss here is their debt level. I want to get your opinion on this. So their debt level is actually quite high. If you look at so their debt in 2018, it's $18 billion, or sorry, not 18 billion, $12.8 billion.
Okay.
Cash on hand, $2 billion. And free cash flow about 950 million.
Okay.
So their debt is quite high. So when we look at return on equity, return on equity becomes negative because equity right now is negative. It's in the hole.
Okay.
So currently, if you look at their balance sheet, equity is negative $1.8 billion.
Okay.
So return on equity seemed like didn't seem like a best way given their high debt level.
Sure.
So I looked at return on asset and return on capital employed.
Okay.
So if you look at return on capital employed, in 2018, it reached 7.38%. Years before that, it was around 5%. So that's return on equity. If you look at return on capital employed, for those of you who don't know what the formula is, it's EBIT in the numerator divided by total asset minus current liability. In 2018, it was 17%, and years before that, it was around there as well, 14%.
Okay.
So that's the ballpark we're talking about here. Return on capital employed about 14%. Return on asset about 5 to 6%.
Okay. So, I mean, from that perspective, we looked at this business. We saw a company that has a very powerful moat. But, I wouldn't call those numbers eye-popping as far as returns on capital, right?
No.
And that it seems to be a lot of that has to do with this $13 billion in debt that they have accumulated.
Yes.
Presumably for acquiring numerous companies, right?
Yeah, absolutely. So
go ahead.
Just a little bit more context on the debt level. So as I mentioned, they're saddled with about $13 billion in debt, and their interest payment alone is basically $650 million.
So,
and that's about 17% of revenue.
Yeah. So it's a fairly significant chunk of their revenue is just being sent to service their debt.
Yeah.
And that's not paying down any of it. It's just the interest on it.
Yeah. So, just the interest payment. Yeah.
So so there's clearly we have to look at, do a little bit more investigation here.
Mm-hmm.
Okay. So does the company have enough cash to maintain its business? I think you mentioned $2 billion in debt, or I'm sorry, $2 billion in cash, $12 billion in debt. So, what do you think about that as far as being able to maintain their current business?
I think being able to maintain their current business, I think it's an absolute yes. So they will be able to continue on this path. They have $2 billion in cash. In terms of liquidity, they have, credit facilities, that allows them to extend their credit and provide for the needs of the business. I don't think that's a problem. If you look at free cash flow, they're generating about $1 billion in free cash flow. So in terms of your question, the company has enough cash to maintain its business. Yes.
Okay, and we'd already kind of discussed this. Do they have reasonable debt levels? And so, the metric that we had used was 3 times free cash flow. And what does that look like?
I mean, debt level, long-term debt, about a little shy over $13 billion, and free cash flow of under $1 billion. So definitely above the 3x that we're looking for here. Some more color on the debt level. The current ratio, which is current asset divided by current liability, it's about 4 to 3. I mean, it's been around 3 to 4.
Okay.
For the last several years.
So plenty of cash, or current assets relative to their current expenses.
Yeah. So that's the current ratio, right? So that's the kind of the immediate within a year kind of horizon. If you look at debt to asset level, it's about 1. So debt divided by total asset, it's about 1.
Okay. Which is not, you know, I mean, since their equity is negative, things become a little more complicated to measure. So
yeah.
Okay, let's look at the you know, they generate free cash flow, but is it enough? You know, given that they are basically going to have to spend, assuming there is no growth, it'd take them 13 years to pay off their debt. You know, they may have to do some financial gymnastics, it sounds like, just to keep, you know, refinance it, keep it going longer. It may affect their ability to actually grow because they're going to have to, you know, borrow money at maybe potentially higher interest rates because, you know, even though they have a strong moat, they're going to have to continue to pay up on their interest payments.
Yeah, for sure. I think this debt is really hurting their return on equity and return on their capital as a whole, and it's really saddling free cash flow and everything else here. So this debt level is a major thorn in the eye for me right now.
Okay. Well, we've talked a little bit about the financials, but you know, maybe we should look at the management here and see if there's any other things that we would be concerned about. We were discussing management for TransDigm, and one of the things that we had, you know, the reason that we look at management is, you know, last week when we talked about Visa, we actually didn't really spend a whole lot of time with looking at management. But it seems like management and their acquisition strategy, you know, if management makes a few bad decisions, it could have a huge impact on the future prospects of the company here. And so management for here is actually a pretty big deal. So, you know, one of the things that we want to look at is what are the management incentives, and are they incentivized to prioritize shareholder interests above their own?
Yeah. I would say one of the things that I liked about their management is that, you know, we kind of trash talk dividend payments because in times like this, it's not really shareholder friendly because it's double taxed. What I liked about TransDigm is that they do one-time special dividend. They don't do continuous dividend payments like many of the companies out there. So they do one-time special dividends. So that's pretty positive for me.
Do you think that there's anything there, you know, as far as the management to protect shareholders, right? You know, so giving out dividends is a good thing if it's appropriately timed. You know, when the stock is expensive, that may be a good thing. But do you feel like there's anything that we would say is you know, that management has a different share structure that, you know, could potentially put their interests, not align their interests with that of the shareholder?
Yeah. So that's the part that I need to do more investigation on is the share class. I read, it's escaping me, but there were a few places that I found where I needed to investigate a bit further, but I didn't have time to. But there might be it might be a case where the share structures are dual share structures with one having greater voting rights. So that could be an issue here. One thing I also didn't investigate is the incentive structure. Usually it's tied to revenue and some sort of return on equity, return on asset, or some kind of performance measurement like that. I didn't really look into that one for TransDigm Group.
Okay. Well, we'll move on then to talking more about we talked about dividends. Have they done any share buybacks as far as returning capital back to the shareholders?
Yeah, they do. They do buybacks on and off. So in some instances, they would actually raise money through share offerings. But they do buy back some shares. For example, in 2000. Let me see. Yeah, in 2017, they spent about 300 million common stock purchase. In 2018, they made money, so they issued stocks and made about $57 million. And all this information is available in free cash flow statement for those of you who are interested. So it's kind of on and off. What we want to, kind of going back to our episode on share cannibals, what we want to look at is for a business that's generating tremendous cash flow, we want to look at companies that are actually buying back shares in a opportunistic, but in a kind of conservative and persistent fashion. And I don't see that here. What they're spending a lot of money on is buying companies. So they've been on shopping spree for some time now, starting in at least in the 10K that I looked at, starting in 2013. They started with a company called Airborne, and then in 2018 they bought about 3 companies, and they're right now, 2019, they acquired a big company for about $4 billion. So I think that's their strategy. Instead of returning money to shareholders, they see more room to grow. So that's why they're, going on shopping spree and buying all these different companies.
Yeah. And we had talked about, capital allocation, in previous episodes, and how proper capital allocation is if you find businesses to buy, that may be the best use of your money because you can continue to expand your moat and get higher returns on capital. In that case, it's actually better than paying a dividend or doing a share buyback. But ultimately, the problem here is that, because of their debt level, buying up more companies may not be the best use of capital, right? And that's kind of it's murky here because what we're looking at is a company that has some good, principles behind it. They have a solid business, but may ultimately lose all of their money because of, their debt. And so that's kind of a concerning problem here to me, listening to this and how much cash they generate and so on, and they're buying larger and larger things and trying to digest a whole cow. It could become a potential problem. So, So let's actually keep going and look at our valuation here before we make any decisions. Kind of walk us through what your assumptions were as far as growth and
sure.
And I guess the first question is, knowing what we've talked about, do you feel comfortable even estimating cash flows going forward?
I think estimation of cash flow is doable. I think there's a level of predictability here. Okay. But kind of to your point, it's really this debt level that I'm mostly concerned about, and I want to add more color to our discussion here. Okay. As I said before, their debt level at the end of 2018 was $13 billion, about $13 billion, a little less, $12.8 billion. If you look at the long-term debt level growth, compounded annual growth rate, 3 years it went up 13%. Over 5 years it went up 17%. This is compounded annual growth rate, so this is growing every year at 17%. If you look at 10 years, it's been growing at 25%.
So which metric is growing at 25%?
Long-term debt.
The debt is actually growing at 25%.
Yeah, the debt grew at 25% if you look at compounded annual growth rate over the past 10 years.
Okay.
And a little bit more color on that. So, I mean, I think, this is, I did kind of 2 versions of valuation. If we were to say that in the future, without this whole debt level, what would the value be, and with it, what would it be? I looked at 2 different scenarios, and we can talk about that in a bit.
Okay. Well, so let's walk through your assumptions now, and tell us what you think future growth rates and, what valuation are you coming to?
Yeah. So let's look at, if you look at free cash flow growth rate over the past 3 years, 5 years, 10 years, it's about 26% for the past 3 years, 16% for the past 5 years, and 10 years is about 18%. Okay. So the free cash flow growth is quite robust. Yep. So given that, I made a conservative estimate of 14% for the next 1 to 3 years, and then next 4 to 6, 10, and then 7 to 8, 10.
Okay.
So 14, 10, and 10. And like we always do, we use just discount rate of 10%. And given the initial free cash flow of about $946 million, and then debt level as well as cash, I looked at that, and the intrinsic value is around $187 per share. Right now, it's trading at about 520.
Okay, so that's
this is not subtracting its debt or adding cash.
Okay.
I'm just looking at free cash flow projection into the future. So not taking into account its debt level and its cash.
All right. If you did take into account the debt level, what would that look like?
So here what I'm doing is I am summing up the future cash, and then I am subtracting debt and then adding cash. That actually leads to a negative $6.
So, so it sounds like the debt level here is a big problem, right? It's
existential problem.
Yeah, I mean, I don't think it's necessarily going to wipe them out, but they're going to end up having to make asset sales or do something to service it. And I think that's going to be a big problem because, ultimately they're going to have to pay it off. I don't know what the terms of their debt covenants are, when that money is due and so on. So, I mean, they may be able to do some magic to make it happen, right? And if it's a very long-term bond, they may be able to pay for it over a long period of time, and then, reduce it. But it's certainly worrisome, right? I mean, if we're looking at a company that had zero debt and it's only worth $180 a share, we would want to be buying this under $100 a share. But that's with no debt, and the debt level is kind of wiping out any calculation of value that we can do.
Yeah, that's with no debt, but debt included in the free cash flow with interest payment. So here's something that I did. I said, okay, let's forget about debt altogether. Somehow, magically, they had $12 billion lying around. They found something, whatever, and they were able to wipe out their debt altogether completely. So no interest payment, no debt level, clean balance sheet, clean income statement with no interest payment. What would that look like? If you assume the same growth rate as we did before, same discount rate, the intrinsic value would actually go up to $318. So right now, as I said before, it's trading at $518 per share. So at that point, it becomes a little bit more reasonable,
right?
To kind of think about this as a potential, as a potential play for a value investor.
Right.
But if you look at debt level, it's just, I've never actually seen this happen to me, like intrinsic value going into negative.
Yeah, I mean, it can happen certainly with a lot of debt. I think what the elephant in the room here is always going to be is if you have that amount of debt, it's going to take a somewhat significant effort to get rid of it. And in doing so, you're going to probably change the nature of the business, right? So any analysis that we're going to do, Becco and I not being insiders in the company, not being the executive or the management team, what would we have to sell off? What would we have to cut back on? What would we have to, change in order for this to go on in the future, right? And so, ultimately, I think this is going to affect the if there were no debt here, this thing was still expensive, right? You're giving up, 2/3 of your current net income is being paid out as debt right now, or interest payment. So there's a fairly significant, drag on earnings right now just because of the debt level.
Yeah, I mean, just to reiterate the numbers here, the long-term debt, as I said, about $13 billion. Interest payment on that is about 20%, less than 20%, 17% of the revenue is going into paying for interest payment. And if you look at free cash flow, right now it's about $1 billion. If you didn't have that, it would be $1.6 billion. So think about the difference there. With debt and no debt.
I think the fact that you have negative equity kind of tells you the whole story, right? Is that if I buy this stock, I basically owe money, As an owner, I owe, I don't, there is no asset here, right? My asset minus liability is negative. So, something has to give. And I think when that happens, the stock price will change. Now, it would be interesting to see what happens in, when the debt, finally gets sorted out. What does this company look like? Because they've bought some fairly significant assets, and they've recently announced that they're divesting of certain things, from their acquisitions for cash. So they're trying to make, get some available cash to service debt. It sounds like, and with only $2 billion in net cash, cash on the books, they still have to come up with another $10 billion or so, right? To get this down. So,
yeah, exactly. And that 10 billion, if they don't come up with some other, some way, if they think that they could pay it off with free cash flow, I don't think they are, but let's just assume that, that's where we get the negative intrinsic value. Even with 10 years of projection with the growth rate that we assign, 14% and 10%, you won't be able to pay it off. That's why you have the negative intrinsic value there. Yeah. So I think it's an interesting case study of how debt could really saddle a great company. Really. I mean, going back to episode 1, we talked about how their competitive advantage was, kind of impenetrable because they were selling multiple parts where they were the only providers in the space. This seemed like a great company where, Warren Buffett of sorts, people of that kind of orientation would purchase. But if you look at their financials, the debt level is what is really saddling the company. And not to say that, debt is a bad thing. Debt is a great thing if you could use it in the right way, at the right time for the right things, right purpose. But excessive debt level is what kills the company. And something that I want to do as a follow-up is, I haven't looked into the management's incentive structure, but I really wonder what that looks like.
Well, I wonder if it has something to do with revenue or, and so the way to grow revenue is to just keep acquiring businesses, right? But I think the bigger, thing here is if you bought this company for $1, right? The whole company was sold to you for $1. You still owe $12 billion, right? $13 billion basically is what you're going to have to pay as the floor for this company, right? If they have negative equity, let's say that they go bankrupt, your equity is going to be wiped out for sure, right? To service creditors, and this company would get broken up, and the assets would get sold to pay off, to pay off the creditors, right? To satisfy the debt. It's a big problem, right? Is that there is no asset here relative to the liability. And so, a lot of people say, well, the book value of a company, for these heavy, for certain companies, it's kind of like an academic exercise. For tech companies, yeah, but for a heavy manufacturing, business, their assets are not, if they sold off, if they sold off the assets here, it's not enough. Now, there is some intangible assets they have with patents and things like that, but they're not on the balance sheet. And maybe there is a significant amount of value there that you could sell to another business, to pay things down. But I would be very concerned here. As a shareholder, the price is just way too expensive, regardless of the financial structure. And then on top of that, you have an enormous amount of debt that you have to service. So,
one thing I want to also point out is, we talked about assets, and how the equity is negative. But actually, if you look at assets, goodwill is $6 billion.
Yeah. So,
and total asset is $12 billion. So you're talking about actual asset of $12 billion or $6 billion.
Yeah, and that's all the assets that they've paid. Goodwill is the price that they've paid over book value for, companies, which tells you that. Is the intangible asset there the $6 billion? The patents, is it worth $6 billion? Hard to say, right? But I do think that there's a debt here that is going to, it's going to have.
I just want to one more clarification. So the total intangible asset is $8 billion, and goodwill is $6.2 billion. Of that $8 billion.
Yeah, but I think.
Either way,
fundamentally the point remains. They've paid over book value for certain things. You're seeing an asset here. Their assets are significantly under, the value of the thing. $6 billion cannot get liquidated, in goodwill, right? To pay off creditors and things like that. Maybe there are some patents. There's some manufacturing processes, things like that they can sell. But I would be very concerned here, and especially since you're way, they're trading at 5 times what we would consider a reasonable valuation for them, with no debt. Right?
Yeah.
So.
Yeah. So it's I think it's a really interesting case study here, as we talked about earlier, with great company, great moat, and the financial structure, the financial organization is a major dent in this whole company.
All right. Well, I think that brings us to the end of the episode. As we announced at the beginning, if you're interested in getting access to the checklist, you can send us an email, info@valueinvestor.org, or send us questions or comments about TransDigm or any other company that you'd like us to review. Also, if you're interested in joining our private Slack community, you can send us an email, and we will be happy to send you an invite.
Yeah, I guess just a really quick comment on the Slack. For those of you who don't know what the Slack is, it's just a messaging board where people can come on and message each other privately, and also amongst each other as a group. So please send us your email and be part of the community. I think this will be really helpful for us, but also for the whole community of listeners. You guys can exchange ideas about value investing. You guys can exchange articles that are relevant, things of that sort. And also have great input into what we discuss on this podcast. We would like to be as community oriented as possible. So please send us an email to join the Slack channel.
Yeah. All right, guys. Thanks a lot for tuning in, and we'll look forward to seeing you on the next episode. Thanks.
Thank you.